Next after the financial statements is the closing entries, the purpose of which is to bring each nominal or temporary account to zero balance by transferring them to the owner's equity account. As discussed in part 1 of my lecture videos on adjusting entries, the nominal or temporary accounts are the income statement accounts, meaning those accounts which can be found in the income statement or statement of comprehensive income, plus the owner's withdrawal or drawing account. Therefore, in doing the closing entries, we need to refer to the income statement columns of the worksheet, as well as to the drawing account under the statement of financial position or balance sheet debit column. There are actually 4 closing entries. The first one concerns all income statement accounts with credit balances. So, we have to look at this credit column and debit each account with an amount written on this column, except the income summary account. The first figure is this 2,400,000, which is the balance of the sales account. Since this amount is a credit balance, to close it, we have to debit the account name sales for the amount of 2,400,000. Then likewise, we have to debit for 17,500 the account name purchase returns and allowances. In addition, this 6,500 must be debited also using the account name purchase discounts and this interest income account in the amount of 9,375. And of course, since closing entries are considered journal entries, being recorded also in the journal, the total debit must equal the total credit. Having debited sales, purchase returns and allowances, purchase discounts, and interest income, our credit should be to the income summary account for the total of these 4 figures, amounting to 2,433,375. We can explain this entry with the words to close nominal accounts in the income statement with credit balances. Please note the date of closing entries, the end of an accounting period. In this particular problem, December 31, 2019. Then, just like adjusting entries, it is advisable to number the closing entries for easier referencing later on. The second closing entry is with regards to those accounts under the debit column of the income statement, starting with this 455,000 worth of merchandise inventory beginning. Remember, I pointed out in part 2 that this is the beginning balance. Because this has a debit balance, to close it, we have to credit merchandise inventory beginning for 455,000. After that, credit also 40,000. Sales returns and allowances. And likewise, credit these sales discounts for 10,500 and so on and so forth up to this last amount of 5,000 under the debit column of the income statement. But what must be the debited account of this second closing entry? Income summary for the total of all the credited accounts. In this case, 2,540,837.50. For the explanation, to close nominal accounts in the income statement with debit balances. And please notice that in writing an explanation for an entry in the journal, you may use 2 or more rows, just so your explanation will not occupy the PR. or money colors. As for the date, since this second closing entry must also be made on December 31, it should not be written again because we already have that date up here for the first closing entry. You only need to write the same date again when you begin a new journal page. The third closing entry is to close the balance of the income summary account, which must be equal to the net income or net loss, as the case may be, to the owner's capital account. You may just look at your 10-column worksheet for the amount of the net income or net loss. Here, amounting to 137,537.50. But of course, you can double check if this is indeed the balance of the income summary account. Remember that in the last adjusting entry to record merchandise inventory end, we credited income summary for 245,000. And then here in our first closing entry, we again credited the same income summary account for 2,433,375. And finally, in our second closing entry, we debited income summary for 2,540,837.50. When those three figures are posted to the income summary ledger, the balance would be 137,537.50, which is the exact amount of the net income in the 10-column worksheet, and of course, in your income statement. Because there is net income in contrast with net loss, the balance of this income summary account is credit, as you can see here. To close this account, what must be done? Debit it. So, debit income summary for 137,537.50 and credit Benipayo Capital for the same amount. Notice the effect of this closing entry on the capital of the owner. The capital increased because it is credited. That's why you learned long ago that net income increases the capital account, and that in the statement of changes in owner's equity or capital statement, the net income is shown as an addition to the beginning balance of capital. For the explanation, we may write something like to close net income to capital, or to close the income summary account to the owner's capital account. And the fourth and last closing entry is with regards to the drawing account, which is also close to the owner's capital account. The drawing account here, amounting to 35,000, is on the debit column of the statement of financial position, which means it has a debit balance. Therefore, to close this balance of Benipayo drawing, we have to credit it and debit Benipayo Capital for 35,000. Explanation: to close drawings to capital. To recap, there are 4 closing entries. First, the revenue and contra expense or contra purchases accounts in the income statement, all of which have credit balances, are debited according to their respective account balances. And then, the income summary is credited for the total amount. Second, the expense and contra revenue or contra sales accounts in the income statement, all of which have debit balances, are credited at their respective account balances, and the income summary account is debited for an amount equal to the total of those nominal accounts. Third, the balance of income summary after the second closing entry, which must be equal to the net income or net loss, must be close to capital. If there is net income, the income summary account has a credit balance. So to close, that income summary account must be debited with a corresponding credit to owner's capital. Conversely, in case of loss, the income summary account has a debit balance, and therefore, in order to close it, it must be credited with a debit to capital. Fourth, the drawing account, which normally has a debit balance, is credited for the full amount of its balance in order to close it with a debit to the owner's capital account. So you see, all the nominal or temporary accounts are eventually closed to the capital account. Their balances at the end of an accounting period are not carried over to the next period, but instead become zero after the closing entries.